Risk is always a prominent factor for banks, but during a year in which financial institutions faced unprecedented challenges driven by the COVID-19 pandemic, organizations' ability to strategically navigate change proved crucial. Amid this backdrop, Moss Adams partnered with Bank Director to conduct the 2021 Risk Survey to explore key risks facing the industry and forecast how banks will emerge from the pandemic. In this video, we'll highlight the top insights uncovered in the survey, as well as factors to keep front of mind moving into the second half of the year. Unsurprisingly, concerns around credit risk increased in 2020. Two-thirds of banks worry about concentrations in their loan portfolio, particularly around segments significantly strained during the pandemic, including commercial real estate and hospitality. Almost all respondents modified loans in the second and third quarters of 2020 to aid their customers during the initial coronavirus wave. Some of these modifications extended into the fourth quarter. Two separate considerations are now in play for regulators' evaluations. So it's important to note that just because your portfolio doesn't receive a favorable rating doesn't mean your bank or management won't. Loans were deferred as businesses shut down and were unable to make payments. If those loans remain in deferral past the third quarter of 2020, regulators might downgrade a portfolio rating. However, bank management could receive a strong rating because the actions they took to keep the bank running and support their customers. This accommodates the current reality but doesn't diminish the fact that portfolios are degrading from a stability standpoint. Banks that have good governance and dictate that they have to enhance their underwriting standards, being strategic about to whom they lend money, what loans they'll continue to carry in goodwill, and which they'll defer, will likely find themselves in a better standing. Annual stress tests are common for banks, even though asset limits for stress testing previously increased. Many of our respondents say their bank expanded the quantity or depth of economic scenarios examined in response to the pandemic. Along with interest rate stress testing, most institutions are taking a deeper dive into the portfolio as a whole. I find that this is driving more stress testing on the viability of collateral for loans and liquidity. Institutions comprehend they'll face increased allowance provisions and write-offs, so they're stress testing the capital side of their organization to see how they can shoulder that burden. Looking forward, banks could focus on concentrated risks within the portfolio and potentially apply different stress testing criteria to those segments that pose greater risk. The pandemic placed a renewed focus on business continuity and disaster recovery. While most organizations had a pandemic provision in their plans following guidance from the FDIC, these only materialized as hypothetical exercises. When an actual pandemic hit, many organizations really had to dig in and adapt from experience. Most banks are changing their business continuity plans as a result, with key improvement areas including formalizing remote work procedures, educating and training employees, providing the right tools to staff, and ensuring the bank's IT infrastructure can adapt in a crisis. Most also plan for at least some employees to work remotely after the pandemic abates, which makes cybersecurity a key concern that boards need to further explore and ensure additional precautions are implemented. Previously, with employees working under one roof, so to speak, there was only one entry point of attack for cybercriminals. Suddenly, with employees working from potentially hundreds of different locations, hundreds of entry points could exist. Factoring in employees' mental state is also a crucial vulnerability. With employees navigating the difficulties of work-from-home life and general stresses of the pandemic, it's easier for cybercriminals to take advantage and deceive people. In their comments, many respondents noted the resilience of their institutions. However, it's important to not get complacent. Organizations certainly weathered the hard times, but the biggest impacts of the past year likely won't be fully visible until the pandemic subsides. Once that happens, some businesses will reopen but may need more capital. Others may close permanently, leaving banks to determine which loans won't be repaid, engage bankruptcy courts, take cents on the dollar for some loans, and write others off. While this past year has been a major learning experience, the lessons likely won't be fully appreciated until early 2022. For the full 2021 Risk Survey results, visit bankdirector.com. An in-depth analysis of the survey is also featured in the second quarter 2021 issue of Bank Director magazine.